I'm going to discuss Chapter 8 Accounts Receivable, or better yet, all the receivables that are associated with the balance sheet. So again, I'm going to be talking about accounts receivable, notes receivable, and any of the other receivables that might be out there in order to make up the balance sheet. Now let's talk about common types of receivables, and we'll actually take a look at journalizing the sales on credit. Now with a receivable, what a receivable is this is when a business is going to sell goods or services to another party on account. So we're not going to take cash right away. We are going to take a promise out there that this person is going to pay us back at a later date. So a receivable basically is a claim against a business or an individual. And again here, what I'm looking for as a business is I'm going to hold out. I'm going to give you the sale today. I'll give you the item today in order for you to promise that you will pay me cash at a later date. So really, that's all a receivable is really a promise out there, or it says a monetary claim, which is agreeable on that one, but it's definitely a promise on the buyer's part that he will pay the seller back at a later date. Now, in accounts receivable, again, you're going to receive cash in the future from customers for services performed today. And usually, with an accounts receivable, they are very much a current asset. Why? Because normally they're going to be converted to cash within 30 to 60 days. So again, accounts receivable is an extremely current asset. And usually it's listed right below cash or maybe a line below cash. So again, accounts receivable is very much a liquid asset that's going to be turned around to cash within about 30 to 60 days. Now, a notes receivable is a little bit different. A note receivable is going to have a longer time period than an accounts receivable. Sometimes notes receivables are called promissory notes, and the reason why it's called a promissory note is both parties have to sign a note or an agreement out there where there has to be a principal amount or the amount that's due plus any interest that's due by a certain due date. So what you need to have on a notes receivable is the actual principal balance. You're going to have an interest rate out there and how long that note receivable is going to be outstanding. Now, the maturity date on a note receivable is normally the date that the note receivable is started, plus 60 or 90 days, however long the note is. So the maturity date is the date on which a note receivable is due. And as such, the person is going to have to pay you both the principal on the note plus any interest that was accrued on the note. And there's some other type of receivables out there. Now, with the receivables, we're looking at, say, examples of receivables. The big ones that that we'll take a look at would be interest receivable, but there could be dividends or taxes receivable also. But usually interest receivable, and when we start talking about notes receivable, you'll see that happening. Now, other types of receivables, again, these are promises that the person will pay you X amount of dollars at a later date. Receivables, these can either be current or long term. Now, if they're a current receivable, they're going to be payable within a 1 year time period. So that's going to designate a current status. Now, if the receivable is going to be paid back in a period longer than a year, that's going to be classified as a long-term receivable. So again, there's definitely a difference out there between current and long-term. You're going to need to know that designation anyway. Current is anything received under a 12-month period. Long-term is anything over 12 months. Now, internal controls on receivables, like we talked about in the chapter on internal control and cash, what you want to have is internal control over cash payments received by mail. But the other thing, too, is you want to have cash controls over your receipts of your cash that are coming in. So again, what you want to have here, what you want to make sure is that the person receiving the check does not have accounting duties also. So if the person receives the check and has access to a customer account, the potential is there for some fraudulent activity, like maybe putting the check into another person's account, or better yet, your own personal bank account. And again, people who are handling cash should not be the ones to actually account for that money also. And the other thing out there too is if you handle cash, you don't want to be in a position to handle credit to customers also or grant credit. Because again, if you're handling cash, you can create bogus credit amounts to make the customer look a lot better than what he or she is doing. Now, recording a sale on credit, here's what you're going to do on that. With the sale, here we've got Smart Touch Learning provides $5,000 in services to Brown on account and sells $10,000 sale price of merchandise inventory to Smith on account as of August 8th. So really, you've got two sales transactions here. You've got one for Brown and you've also got one for Smith. So for the one for Brown on August 8th, we're going to make a debit to accounts receivable for Brown for $5,000 and a credit to sales revenue of $5,000 also. Now on the Smith side, Smith sale, we're going to debit accounts receivable Smith for $10,000, and we'll also credit the sales revenue $10,000 also. So this is how we record the sales on credit. So again, this is what our control account is going to look like. The accounts receivable, with the accounts receivable, the entry that we made in the prior was to the subsidiary ledger accounts, like accounts receivable Brown. The Brown and Smith would be subsidiary ledgers. It would be a subset of the actual master account or control account of accounts receivable. So what's happening here is the total for the subsidiary ledgers is $15,000 for both Brown and Smith, and that should be the balance in the accounts receivable control account of $15,000. Now, recording sales on credit, here's where we're going to collect the cash on August 29th. So on August 29th, we got $4,000 from Brown and $8,000 from Smith. So we've got $12,000 in cash in total. So I'm going to debit cash for $12,000, and then I'm going to credit the accounts receivable for Brown for $4,000, and then I'm going to credit the accounts receivable for Smith for $8,000. So again, both accounts have a reduction in their accounts receivable because they came forth and sent the cash in to Smart Touch. Now in this case here, after posting, the subsidiary accounts, Brown's account is going to go down by $4,000. So he's got a balance as of $1,000 at the end of the period. Smith's account is going to go down by $8,000. So she's got a balance of $2,000 at the end of the period. So really, the balance in my AR at the end of the month is $1,000 plus $2,000. So my balance in my AR control account should be $3,000 also. And if it's not, there must be a posting difference or something like that. Now, decrease in collection. The problem with credit sales is this. You have to wait for the cash. With the operating cycle, again, you want that operating cycle to go as quick as possible. So from the time that you buy a product to the time that you sell a product and get the cash, you want that operating cycle going as fast as possible. The problem is with credit sales, this slows the operating cycle process down. Why? Because you have to wait for the cash from the customers. So you have to wait for that cash from the sale on account. The other thing out there is some customers out there just aren't going to pay you. So you'll never get the money from the customer. They've got the product and you've made the sale, but unfortunately you're on the hook because you haven't gotten the cash for that. So there's a number of things that you can do here with trying to decrease collection time, and that's another reason why companies offer credit sales is because they can get their cash in at a quicker time. Or we can also factor or pledge receivables, where we can actually sell all our receivables to a factoring company, say for maybe, I don't know, 50, 60, 70% on the dollar. You've got the money right then and there, and the factoring company is on the hook for getting the money from the customers. So if they get the entire AR balance, that difference between what they get and the amount that they sold or purchased the receivables for is their profit. So again, it's profitable business out there. Now, let's take a look at number one. A receivable occurs when a business A loans money to another party, B, sells goods or services to another party on account. C, has a monetary claim against a business or an individual. Or D, all the statements are correct. Ooh, that's an interesting one. Now, B is definitely a solid answer here. And it sells goods or services to another party on account. So I like B all the way. C, has a monetary claim against a business or an individual. That's true also. And then loans money to another party, well, that would be a notes receivable. So number one here, I definitely like, let's go with D on this one. All the statements are correct. Number two, which of the following statements is true? AR or accounts receivable, and I'm going to be using AR as the acronym. AR is more liquid than cash. No, cash is the most liquid asset of all. Notes receivable are always classified as current assets. That's not always true because you can have a long-term note receivable also, something that can be paid off over a 12-month period. Notes receivable usually have longer collection terms than AR. I like that one. And then accounts receivable are liabilities. No, that's false. D, accounts receivable is an asset. Number two, the answer on this one is C. Number three, which of the following statements regarding notes receivable is incorrect? A, notes receivable usually have longer terms than accounts receivable. That's very true. A notes receivable is a written promise that a customer will pay a fixed amount of principal plus interest by a certain date in the future. Again, very true. All long-term note receivable or all notes receivable are considered long-term assets. No. And then notes receivable are sometimes called promissory notes. Definitely, I like C on that one. Not all notes receivable are long-term assets. Most notes receivable are short-term or current assets. Number four, which of the following should be classified as a long-term asset? Notes or A, interest receivable? No. B, accounts receivable? No. C, note receivable due in 5 years? Definitely. C is the answer. Because again, it's due in 5 years, so that's going to consider it a long-term asset. Number five, a business maintains a subsidiary account for each customer. On May 15th, the business provides services on account $1,900 to customer J. Anthony, $4,900 to customer A. Martin, and $1,300 to customer S. Lee. Which journal entry is needed to record these transactions? Again, I'm going to debit my accounts receivable and credit my sales revenue. So in this case here, I want to debit AR J. Anthony 1900, AR A. Martin 4900, AR S. Lee 1300, and credit the service revenue of $8,100. Number five is B. And that's the case. It wouldn't be D because we're not going to be debiting or crediting to the control accounts. We'll put it to the accounts receivable, perhaps to the subsidiary, and the subsidiary account should roll up into the control account.